Okay, guys, today we're heading out to regional New South Wales. We're comparing some of the most well-known markets for regional New South Wales: Dubbo, Orange and Bathurst. Just keep in mind for all of these metrics that Bathurst, we're just looking at Bathurst City Central. We're not looking at West, East, Kelso, all of the other markets in there. But we're going to be looking at about 20 different metrics to see where the market is currently, what we think it's going to do in the future, and what it's done over the past 10 years. So we'll get straight into it. Economic diversity, all very similar. Bathurst is slightly higher than the other two, but all very similar for the diversity within the economy. Then we got public housing, again, 5 and 6 for Dubbo and Orange, slightly lower for Bathurst. School rankings, all very similar. Population to dwellings, again, all very similar. Bathurst is obviously lower, but you've got neighbouring markets that we're not considering in this video. There is a clear imbalance there, but it's still in line with that 2 to 2.5 persons per household. It's not like there's a significant imbalance in terms of supply there. When we're looking at the supply and demand dynamics in that market at the moment, we're not looking at these over a long-term time horizon. This is purely just what the market's doing at the moment. But vacancy rates, all of them ultra low. Bathurst is the highest at 1.79%, but then Dubbo, you've got vacancy rates of less than 1%. So many people have bought in Perth and Adelaide and chasing all of these affordable markets for ultra low vacancy rates. We've got one of the biggest regional towns in New South Wales with a vacancy rate less than 1%. Inventory all got less than 1 month worth of supply of property. So they're all tightly held markets. Hold periods, I would like to see them slightly higher, above 10, but that is a really typical and acceptable time period for those local owner-occupied demographics to be holding onto their properties. Days on market, there's a bit of difference within the days on market, so how fast things are trading. Dubbo's obviously, again, complementing those vacancy rates. It's an ultra-tight market. Properties are trading within 33 days, which is that typical 4-week letting buyers come through open homes or running an auction campaign. Orange, they're taking a little bit longer. Bathurst, it's starting to get too drawn out to take, there's obviously liquidity risk once you're starting to get around that 6, 7 to 8 week time frame to be selling in such an affordable market. If it was 60 days and we're talking about north of $3 million markets, well, then that's acceptable. But for such an affordable market to be taking so long to trade, that's a slight red flag for me. And it could be purely tied to the affordability index. Affordability index is highly applicable for all of these markets because they're at that sub $800,000 price. Units to houses, as you can see, there's actually a lot more units in the Bathurst market compared to these other Orange and Dubbo markets. Orange and Dubbo, not a lot of units there. I think that is changing for Dubbo at the moment with a lot of the building height increases. Renter to owner ratios, this is a big one for these markets, especially being regional. Bathurst at 43%, which is probably why it's complementing that higher vacancy rate, but still a low vacancy rate for such a saturated unit market. That does raise concerns to me if I was looking to invest in Bathurst, because you're competing with 53% of the market for other investors and trying to collect those tenants to pick your property over somebody else's. So you can always achieve it. Just make sure you're coming back to scarcity and you're buying an asset that the biggest cohort of renters want in that market. Buy something that's going to stand out compared to what everybody else owns. Socioeconomics for that market, they're all very similar. Bathurst being the lowest at 3 out of 10, Orange the highest at 5 out of 10. Whether there's some sort of capacity for gentrification in these markets, I doubt that there's going to be a big influx of a new demographic to change it significantly, but it's worthwhile looking into to see if there's any upside there. Growth pattern deviation, the only one showing out for, growth pattern deviation is Orange. And we'll get to that 1 to 10 year time horizon shortly. Spillover potential, they're showing that the only market showing good spillover potential is Bathurst. I'm not going to go too much into that. I'd have to analyze each individual market to go into more depth. In terms of volatility, they're all just a 5 and a 6 out of 10. So it's just moderate volatility for these markets. If you did see the growth rate cycles, there is a natural ebb and flow for growth, but a good sign that I've looked at into before, they're all very consistent that during contraction phases, they don't go below negative growth. So no matter what year you buy or what year you own in these markets, there is some sort of growth, and they don't tend to go below that negative, as they're going through their contraction phase. it's typically just getting down to 1 or 2% growth during those years. Yields are sort of trading at 3.5%, which isn't ideal. I know that in all markets you can get above this typical yield. I purchased a property in Dubbo for a client about 12 months ago, $640,000 4-bedroom brick veneer property. We actually leased that for $680,000, and so that's a 5.5% rental yield. That's caters to the biggest demographic in that market because you have ultra low vacancy periods, and you typically cater to the best type of renter in that market, and you can achieve a higher yield. In terms of growth rates, as you can see, similar, but there are some things to highlight. So obviously, first thing to highlight is Orange being 120% growth over 10 years compared to Bathurst of 5%. Doesn't seem like too significant at 25% growth, but if you're buying a $500,000 house in these markets, you're talking about in 10 years' time, there's a difference of value of either 1 million being Bathurst or 1.1 million being Dubbo. So I don't know about you, but if I'm buying property, I like to make as much money as I possibly can, and an extra $100,000 goes a long way, especially for a purchase price of only $500,000. If you're going into that $1 million, $2 million markets, you're talking about a pretty significant amount of money that you're missing out on by buying in the wrong market at the wrong time. And what I mean by timing, you can see that. Obviously, Dubbo here has done 18% over the past 3 years, but Orange has gone negative 5% over the last 3 years. So think about that. If you bought in Orange 2 years ago, 3 years ago, and you're a high income earner, you wanted to expand your portfolio and grow rapidly. If you bought in Orange, you're sitting on your hands waiting for your equity to go, and you're trying to save more money to buy, as opposed to Dubbo. 18% growth over 3 years. I would have wanted to buy it to get more than that. But as you can see, over the 1 year period, it's starting to accelerate a lot faster. You can see that in the quarterly and monthly growth as well. But significant difference if you're trying to expand your portfolio. If you bought in Orange 3 years ago as opposed to Dubbo, at least in Dubbo, you would have had some sort of equity that you've gained already that you can extract and go and purchase again. Whereas Orange, again, you're just relying on whatever you've saved during that period. Same thing for yearly growth. I mean, Orange is starting to accelerate. You can see the difference in that 5 to 1 year growth, but it's still not as fast as that Dubbo market. 9% over the past 12 months. It's higher than average growth for most markets, but absolutely a regional market. Orange and Bathurst are still low, but whether that's a signal that this market's starting to accelerate, and we're going to see some of that spillover and growth pattern deviation start to take place. Interesting signs, they're all starting to trade around the similar monthly figures. So watch this space for all of these markets. But again, this is just highlighting that you need to be buying in the right market at the right time to make sure that you're extracting equity over that 1 to 3 year period. But ultimately, so you make sure that you're making as the most money possible over that 10-year time horizon. That's it for these regional markets. Let me know in the comments what market you think you want to buy in. And if you like these videos, hit subscribe. I'll see you on the next episode.